The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Good afternoon. Welcome to another episode of Fix It Friday. I'm coming to you today live from Boca Raton, Florida. So for those of you I left in New York a couple of days ago with the 30-degree weather, I apologize, but hopefully seeing the sunshine behind us will warm you up at least a little bit if you happen to be watching the podcast today.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
So today I'm going to talk to you about something called performance chasing. And I think it's very timely because I've noticed that a lot of people who are interviewing us and a lot of the investment public that I come across in various settings, wittingly or unwittingly, are engaging in performance chasing. So what is performance chasing? Essentially, when we look at a random benchmark, let's call it the S&P 500, and it's done well for the past couple of years relative to a lot of other components in a well-diversified portfolio, we start to feel like we shouldn't be in the other diversified components. We should have everything in the component that's doing the best for the last couple of years. And in doing so, we put our plan in jeopardy, even if we don't realize it. So I'll explain today why that is. So there's a few reasons that we engage in performance chasing. So let me just go over those first. One of them is FOMO and envy. So the fear of missing out. There's a famous author, Charles Kindleberg, who wrote a book in our industry called Manias, Panics, and Crashes. And one of his quotes from there is, "There's nothing more harmful to one's well-being and to one's judgment as to see a friend get rich." So our judgment gets distorted simply because we're seeing others get richer than we are. We also like to herd. It's just a survival mechanism. So we like to go with the crowd. We'd rather be wrong conventionally, meaning wrong with the crowd, than right unconventionally, standing against the crowd. So in performance chasing, we feel like, well, if everybody else is doing it and they're making money, even if it doesn't work, at least we're all together. And that's just one of our survival instincts. So the other problem we have is something called a flawed behavioral bias as it relates to how we process economic and financial inputs. So in life, we're generally attracted to goods and services when they are seeing their prices come down, or colloquially known as they go on sale. And we're repelled by higher prices. We'll delay a purchase of something that goes up. We behave that way with every economic and financial input except one, and that's the price of stocks. When the price of stocks is high and rising, investors like to chase those high prices, somehow thinking that by paying a higher price for a company's future earnings, my returns will be greater than if I paid a lower price.
Conversely, when great companies go on sale, investors think that by buying at lower prices, they're actually taking on greater investment risks than when they buy at higher prices. They also believe that when they're buying at lower prices, somehow their future return on the investment will be lower instead of what will actually happen, it'll be higher because they're paying lower prices.
So in just that one way, we process economic inputs the opposite of we do with every other economic input outside of investments. And then finally, what we do is we're seeking to avoid pain. So when we talk about planning, which is one of the essential elements for success in terms of protecting our wealth over time, which is to say we need to have a plan. And usually it should be a plan that's date specific and dollar specific. Something like, by age 65, I want to have $5 million because I need to spend $200,000 a year to retire comfortably and stay that way. Most people don't have a plan, partially because planning can be painful. I might have to say, if I want to retire at 65, that means when I'm 45, I can't take as many vacations. I've got to save more, and I've got to enjoy less. And that's something that human nature doesn't like to deal with. So rather than deal with it, let us chase the highest performing things and hope that we hit the lottery, and that will avoid the need to do planning. So those are the main reasons. Well, let me give you an example in recent years of one of the most egregious fund performance chasing episodes that's been documented in modern history by Morningstar. And that is a fund called the ARK Innovation Fund, run by a woman named Cathie Wood. She became very famous in 2020. Her fund returned 150%, and it was investing in what was called technological disruptor firms, things like Zoom and Teledoc. When people couldn't get out of their houses because of the pandemic, they were doing all the meetings from home through Zoom, and the stock price went through the roof. So problem is, most investors, when they get into a fund that's been up 150%, they might have had a little investment in it early on when it made 150%. But after the 150%, they want to go all in. And so in Cathie Wood's case with the ARK funds, what was documented by Morningstar, that her fund made 9.5% a year for the decade ending in 24. The same time, the average investor in her fund lost 17% a year. So she made 9.7, and the investors in the fund lost 17% a year. How did that happen? Because the investors put most of their money in after the 150% decline, and so they suffered in 2022 her 70% loss when the S&P 500 only lost 18%. So the majority of their money was in for the down 70, and only a minority of their money was in for the up 150. And so what Morningstar found is that Cathie Wood's ARK fund, by measuring the cash flows investors put in and out of the fund and when, they were able to calculate the fact that they actually lost 70% a year. And they destroyed, the fund that destroyed $14 billion of investor wealth over that period. It ranked her at the top of Morningstar's list of what were called wealth destroyers for the past decade. So that's a most recent lesson. In general, the top fund performers in 2010 that were up for, there were 5 of them. They were for the top funds of the decade. All 5 of those funds for the next decade, from 2011 to 2020, underperformed, every single one of them, by an average of 5%. So this is not particular to Cathie Wood. This is a behavior that we must avoid if we want to succeed with our investments over the long term. We've got to stay diversified, and we've got to not look left and right at what everybody else is doing. In the short term, we should stay what's worked always over the long term, not what might be working today in the short term. So one of the examples I like to give to make an analogy, if you're ever on the highway and there's 3 lanes and you see that driver who's weaving out of the lanes, going from the fastest lane to the slowest and back and forth, they don't realize the average lane speed is the same. If you just stayed in one lane, you will get there almost always at the same time. But what they also don't realize is the only thing they're increasing by changing lanes like that, and the investor is increasing by chasing performance like they do, is failing to make it to the end of the journey at all. The driver will get into an accident, could be fatal, might not be. The investor, similarly, could be fatal to their financial future. And so very, very important to do that. When we're chasing performance today, we're doing, at least for those of us who look at the recent performance of the S&P 500 for the last couple of years, which was about 25% a year. We don't realize that the index today is it's the most heavily concentrated in one industry, happens to be the technology industry, and it happens to be about 40% of the index's composition today. So 40% of our future financial success, if we're putting it all into the S&P 500 today, is dependent on one industry, and frankly, 7 companies within that one industry out of the whole 500. This is very reminiscent of what happened in 2000 before the technology bubble burst, except the names were different. The technology sector was 33% of the S&P back then versus 40% today. Back then, 33 was a record. And people were chasing a number of companies, different names: Lucent Technologies, America Online, Cisco Systems. And Cisco stands out to me because it reminds me today of NVIDIA, in that Cisco back then became worth $500 billion and overtook Microsoft as the most valuable company in the world. And analysts were saying it would go up to $1 trillion. the same way they're predicting NVIDIA will go up indefinitely today. And what in fact happened is 25 years later, as good a company as Cisco was, and is, because it was making routers that were the connectivity device for the internet, which was the future back then in 2000. So the narrative sounded great, but nonetheless, paying too much for anything is never a good idea. Today, it's not worth 500 billion as it was 25 years ago. It's worth 250 billion. What does that mean in English? It means investors who put $1 million in Cisco in 2000 today have $500,000. So wasn't a very good investment decision to chase that performance back then. And in all my experience, I suspect that today investors chasing performance won't fare much better. Now, the people who did that back in 2000, the next decade, meaning 2001 to 09 for the S&P, was a lost decade, down 30%, the price of the stocks in the S&P. At the same time, international emerging markets were up 200%, small caps were up 70 or 80. So if people would have just stayed diversified, they would never have experienced that lost decade. And so investors lost in a few ways. One is they sold tomorrow's winners to buy tomorrow's losers. They actually hurt their plans to a point where they might never recover from it. And finally, because they blame outside factors for their failure, they say, gee, the investment markets are just too risky. They don't admit what really happened, which is they changed from being long-term investors to being speculators on trends that were not likely to continue, which were dramatic increases in earnings and stock prices in a certain sector. So what they do then to avoid future regret, which is the most powerful financial emotion because it's something that never goes away, long-term regret, is they just do status quo buys. I'm going to leave it all in cash for an extended period of time, and that'll make sure I don't ever have to face the regret of seeing that kind of big decline for a decade that occurred from my performance chasing. And so I'll leave you with a couple of thoughts. Howard Marks, who's one of the most well-known in our industry, long-term investors, runs a firm called Oak Tree Management, very bright individual. He says that for the past 50 years, he was guided by three principles to succeed. One is, it's not what you buy, it's what you pay that counts most. Two is, good investing doesn't come from buying good things, but from buying things well. And the third is, no asset is so good that it can't become overpriced and thus become dangerous to you. And few assets are so bad that they can't become cheap enough to represent a bargain. So should always remember what game we're playing. We're playing the long-term compounding game. It's about finding the returns that we could sustain, average kinds of returns for the longest period, because compounding is about average returns for long periods of time, where time does all the heavy lifting. And then finally, I want to talk about true diversification. I recently ran into a potential client who had 4 different funds, and they said, oh, I'm well diversified. Each of the 4 funds had the same top 40% exposure to the internet. Just as many people that I saw in my career in the late 90s and 2000 are doing. I call it diversification in name only, or DINO diversification. They're not really diversified. The example I'll leave you with is if I own an umbrella company and it's been raining incessantly for 6 months, my sales are through the roof. I'm investing in all kinds of umbrella inventory, extrapolating the last 6 months into the future. And I have a smart friend who says, that's not going to happen. We're going to have a drought at some point. You've got to start diversifying your business. Don't buy all this umbrella inventory. I said, you know what? You're right. I've been buying only black umbrellas. I'm going to buy red, orange, yellow, and green so I can diversify. No, he said, you've got to buy suntan lotion. No one's going to buy any color umbrellas. That's not true diversification. So that's an example outside of finance of diversification in name only. And finally, I'll encourage everybody who might think they fit in the category where they might be performance chasing right now, is when you're looking for an excuse to continue a certain activity, don't engage in what's called a confirmation bias search. Don't search with a term in Google that says, hey, tell me why the S&P 500 is likely to continue to outperform for the next decade. Search the opposite. Why is it likely the S&P 500 will not perform well for the next decade? So those are some tips on how to avoid and counter performance chasing behavior. I hope that you found this podcast to be helpful, and you can listen to it on all your favorite podcast venues. You could catch us on the crazywealthypodcast.com website or our Fusion Family Wealth website. And until next time, Jonathan Blau signing off. Thanks for joining us.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.